Have you ever wondered how you can make your money work for you? Well, today we're going to talk about something that might just allow you to do that. A concept that's been around for centuries and has been the cornerstone of many a fortune made: investing. Now, you might be asking, what exactly is investing? Well, it's pretty simple. Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. You're essentially buying assets that you believe will increase in value over time, providing you with a return on your investment. You might think, well, that sounds like saving. But here's the key difference. When you save, you're simply setting aside money for future use, often in a safe and accessible place like a bank account. But with investing, you're actively seeking to grow your money. Think of it this way. Imagine your money as a seed. If you simply put it in a drawer and leave it there, it remains a seed. But if you plant that seed, give it sunlight, water, and care, it grows into a tree. That's what investing does for your money. It gives it the chance to grow. Investing can lead to financial growth and independence. It can help you build wealth over time, even as you sleep. Your money is out there working for you day and night. It's like having your own personal army of dollar bills, marching out to bring back more dollars. But remember, with great power comes great responsibility. Investing involves risk, and it's not a get-rich-quick scheme. It requires patience, knowledge, and discipline. It's about understanding the market, making informed decisions, and playing the long game. So are you ready to turn your hard-earned cash into a money-making machine? To start investing, you first need to understand the basics. Let's kick off with stocks. Imagine owning a slice of your favorite tech company or coffee chain. That's essentially what a stock is, a share in the ownership of a company. When you buy stocks, you're buying a piece of that company's future profits and potential. Next on the list are bonds. Think of bonds as IOUs. When you purchase a bond, you're essentially lending money to a corporation or government. In return, they promise to pay you back with interest at a later date. Bonds are often seen as a safer bet than stocks, but with potentially lower returns. Now let's talk about mutual funds. These are like baskets of investments. They pool money from many investors to buy a diversified mix of stocks, bonds, or other assets. Mutual funds offer diversification and professional management, but come with their own set of fees and risks. Speaking of diversification, it's a crucial concept in investing. It's all about not putting all your eggs in one basket. By spreading your investments across different types of assets, you can potentially reduce risk and improve returns. The key to diversification is balance. If one investment performs poorly, others might perform well and offset the loss. And finally, the importance of understanding your own risk tolerance. Investing always involves some level of risk. Your comfort with that risk is a personal decision, influenced by your financial situation and life stage. Determining your risk tolerance can guide you towards the types of investments that are right for you. Remember, investing isn't about getting rich quick. It's about steadily growing your wealth over time. You don't need a fortune to get started, just a basic understanding, a plan, and the discipline to stick to it. With these basics, you're now ready to dive deeper into the world of investing. Before you start investing, it's crucial to set your financial goals. Just like a sailor charting a course, your financial goals will guide your investment journey. They serve as the lighthouse, illuminating the path that will lead you to your desired financial future. So, how do you set realistic and achievable financial goals? Well, it's a three-step process. First, know your why. What is your purpose for investing? Is it for your retirement, a dream house, your child's education, or perhaps a world tour? Your why will not only motivate you, but also help you decide on the amount you need to invest and the risk you're willing to take. Second, make your goals SMART. Specific, measurable, achievable, relevant, and time-bound. A vague goal like, I want to be rich, is not going to cut it. Instead, say, I want to accumulate $1 million in the next 20 years through investing. Now that's a SMART goal. Third, break your goal down into smaller, manageable steps. If your goal is to save $1 million in 20 years, figure out how much you need to save and invest each year, each month, and even each day. This makes your goal less intimidating and more manageable. But why are clear, defined goals important for successful investing? Well, having clear goals helps you stay focused and disciplined. It prevents you from making impulsive decisions driven by market hype or fear. A defined goal also allows you to measure your progress and adjust your plan as necessary. Moreover, your financial goals determine your investment strategy. Are you going to be aggressive or conservative? Will you invest in growth stocks or dividend-paying ones? The answers to these questions hinge on your goals and the timeline you've set to achieve them. In conclusion, setting clear and realistic financial goals is the first and arguably the most crucial step in your investing journey. It's like setting the destination in your GPS before you start the engine. Remember, a goal without a plan is just a wish. So, set your financial goals today and start your journey towards financial freedom. In the world of investing, risk and reward go hand in hand. Let's imagine it as a dance, a tango if you will. The dancers, risk and reward, are inextricably intertwined, their movements reflecting the rhythm of the marketplace. Each step, each twirl, represents a decision made by an investor, and with every decision comes a potential for profit or loss. So what is risk? In the simplest terms, it's the possibility that your investment may not provide the expected return, or worse, that you might lose some or all of your initial investment. There are different types of risks: market risk, credit risk, inflation risk, and even the risk of outliving your investments. On the flip side, there's reward. That's the potential gain you might achieve from your investment. It's the reason you invest in the first place. The reward could come in the form of dividends, interest, or a rise in the value of your investment. Now, here's where things get interesting. Different investments come with different levels of risk and potential returns. For instance, government bonds are considered low risk, but they also offer lower returns. On the other hand, stocks have a higher risk, but they also have the potential for higher returns. Naturally, you might think, I'll just go with the low-risk options. But hold on, while it's true that low-risk investments are less likely to lose money, they're also less likely to make significant gains. And if your investments don't outpace inflation, you could actually lose purchasing power over time. That's why it's crucial to understand your own risk tolerance. Some people can handle the roller coaster ride of high-risk investments, while others prefer the slow and steady pace of the low-risk options. There's no one-size-fits-all answer here. It's about understanding your financial goals, your timeline, and your ability to withstand potential losses. So, yes, in the world of investing, risk and reward do dance together. But remember, you're the choreographer. You get to decide how fast or slow, how high or low they go. The key is to find a balance between risk and reward that aligns with your financial goals and risk tolerance. Choosing the right investment can be a daunting task, but we're here to help. When it comes to selecting the perfect investment, it's vital to consider your financial goals, risk tolerance, and investment horizon. Let's break down what that means. Firstly, your financial goals. Are you saving for a new car, a house, or your retirement? Your goal will determine what kind of investments you should be looking at. For short-term goals, you might want to consider safer investments like bonds or money market funds. For long-term goals like retirement, you might be able to afford to take more risks and thus consider stocks or real estate. Next, we talk about risk tolerance. This is a measure of your willingness and ability to bear losses. If the thought of losing money keeps you up at night, you'll probably want to stick to lower risk investments. On the other hand, if you're comfortable with some level of loss in the pursuit of higher returns, you might be open to investing in riskier assets. Then comes your investment horizon. This refers to the amount of time you expect to hold an investment before cashing it in. Similar to your financial goals, your investment horizon can influence the type of investments you choose. The longer your investment horizon, the more risk you can theoretically afford to take on. Doing thorough research before making any investment decision is crucial. This includes understanding the investment product, its potential returns, risks, and costs. The more you know about your potential investment, the better equipped you'll be to make an informed decision. Lastly, remember that there's no one-size-fits-all solution when it comes to investing. What works for your friend or family member may not work for you. It's important to create an investment strategy that aligns with your specific circumstances and goals. Remember, the right investment for you depends on your individual circumstances and goals. Now that you know how to choose the right investments, it's time to build your portfolio. Picture your portfolio as a garden. It flourishes best with a variety of plants, each serving a unique purpose. Similarly, a well-rounded investment portfolio is a blend of different types of investments, each contributing in its own way to your financial growth and stability. So, how do we start building this financial garden? Let's break it down into steps. Step 1. Diversify. The phrase, "don't put all your eggs in one basket," holds true in investing. Diversification, or spreading your investments across different asset classes, such as stocks, bonds, real estate, and more, can help manage risk. If one area underperforms, others may do well, balancing out your overall returns. Step 2. Understand your risk tolerance. Every investment comes with some level of risk. It's important to assess your own comfort with risk, which can be influenced by factors like your financial goals, age, and financial circumstances. A younger investor may be more comfortable taking on riskier investments with potentially higher returns, while someone nearing retirement might prefer safer, steadier options. Step 3. Align with your financial goals. Your portfolio should reflect your financial aims. If you're saving for a down payment on a house in 5 years, you might opt for more conservative investments. However, if you're saving for retirement in 20 years, you might lean towards investments with higher growth potential. Step 4. Regularly review and rebalance. It's not enough to just set and forget your portfolio. Regularly reviewing and adjusting your investments can help ensure they're still aligned with your goals and risk tolerance. And there you have it, 4 steps to building a diversified investment portfolio. But remember, Rome wasn't built in a day. A well-crafted portfolio takes time, patience, and a little bit of financial green thumb. A well-built portfolio is your ticket to financial success. And with these steps, you're well on your way to crafting a portfolio that serves your unique financial needs and goals. Investing is not a set-it-and-forget-it kind of deal. Regular monitoring is key. It's like tending to a garden. If you want it to flourish, you need to water, prune, and sometimes replant. So how does this translate to the world of investing? Well, let's start with the importance of regularly reviewing your portfolio. It's like a health checkup for your investments. This gives you an opportunity to see how your investments are performing and whether they're on track to meet your financial goals. Are your stocks soaring or sinking? Is your bond yield as expected? Are your mutual funds giving you the desired returns? Regular reviews can help answer these questions. But it's not just about checking the numbers. It's also about understanding the reasons behind those numbers. Why did a certain stock perform well or poorly? Was it due to company-specific news, industry trends, or broader economic factors? Understanding the why can help you make more informed investment decisions in the future. Now, based on your review, you might need to make some adjustments. This doesn't necessarily mean panic selling at the first sign of a downturn. Remember, investing is a long-term game, but it does mean rebalancing your portfolio from time to time. Let's say one of your investments has done exceptionally well and now constitutes a larger portion of your portfolio than you'd like. You might consider selling some of it to bring your portfolio back into balance. Changes in your personal circumstances can also warrant adjustments. Has your risk tolerance changed? Are your financial goals different now? If so, your portfolio should reflect these changes. And finally, remember that while monitoring your investments is important, it shouldn't become an obsession. Watching the markets every minute of the day can lead to stress and impulsive decisions. So, find a balance. Set a regular schedule for reviewing your portfolio, but don't let it consume you. Keep a close eye on your investments, and they'll thank you in the long run. After all, your investments are not just numbers on a screen. They're the seeds of your financial future. Scene script. Have you heard of the 8th wonder of the world? It's called compounding. Now let's delve into this captivating concept. Compounding, in the realm of finance, is a magical process where your money makes more money. Yes, you heard right, your money works for you. Imagine planting a seed in fertile soil. Over time, that seed grows into a tree and that tree bears fruit. Now, if you plant the seeds from that fruit, you'll have more trees and even more fruit. This is the essence of compounding. It's the process of growth upon growth. Gains on top of gains. When it comes to investing, compounding can be your best ally. Here's how it works. You invest some money. and it earns a return. The next year you earn a return not only on your original investment, but also on the return from the previous year. This process repeats year after year and your wealth grows exponentially, not linearly. To put it in perspective, let's say you invest $1,000 at an annual interest rate of 5%. After the first year, you'll have an extra $50. But here's where the magic happens. In the second year, you're earning interest not just on your original $1,000, but also on the $50 you earned in interest the first year. So, your total interest for the second year would be $52.50, not just $50. And it continues to grow. The key to maximizing the power of compounding is starting early. The earlier you start investing, the more time your money has to grow and multiply, and the greater the impact of compounding. Think of it as a snowball rolling down a hill, gathering more snow and growing larger as it goes. Remember, time in the market beats timing the market. So don't wait for the perfect time to invest. Start now and let the power of compounding work its magic on your wealth. Now that you understand the power of investing, it's time to get started. Begin by setting up an investment account. This account will be your gateway to the financial markets, where you'll have the opportunity to buy shares of companies, bonds, or other types of investments. There are numerous online platforms available where you can open an account, many of which offer tools and resources to help guide your investment decisions. Once your account is set up, it's time to fund it. This can be done by transferring money from your bank account. The amount you start with isn't as important as simply getting started. Whether it's $50 or $5,000, the key is to begin. Now comes the exciting part, making your first investment. But before you dive in, take a moment to reflect on your financial goals. Are you investing for retirement, to buy a home, or perhaps for your child's education? Your goals will help guide your investment decisions. Next, consider your risk tolerance. All investments come with risk, but some are riskier than others. If the thought of losing money keeps you up at night, you might opt for safer investments like bonds. On the other hand, if you're comfortable taking on a bit more risk for the potential of higher returns, stocks may be more your speed. Once you've considered your goals and risk tolerance, you're ready to make your first investment. This could be buying shares of a company you believe in, purchasing bonds, or investing in a mutual fund. But remember, investing isn't a one-time event. It's a lifelong journey. So continue to monitor your investments, adjust as necessary, and keep adding to your portfolio over time. Finally, don't forget about the power of compounding. As your investments earn returns, those returns can be reinvested to earn even more. Over time, this can lead to significant growth in your portfolio. With these steps, you're now ready to embark on your investment journey. Investing may seem complex at first, but with knowledge and patience, it becomes a powerful tool for financial growth. That's a wrap, folks. We've journeyed together through the formidable world of investing, dispelling myths and understanding key concepts. We have explored the power of investing, the thrilling dance of risk and reward, and how setting clear financial goals can steer your investment journey. We've delved into the basics, the ABCs of the financial world. It's not rocket science, it's simply understanding terms, knowing how to read the market, and making informed decisions. We've also looked at choosing the right investment. Remember, there's no one-size-fits-all. Your investment should align with your financial goals and risk tolerance. We've also discussed building a robust portfolio. Diversification is your best friend here. It's about spreading your investments across different asset classes to balance risk and maximize returns. Then we moved on to the power of compounding. Albert Einstein wasn't kidding when he called it the eighth wonder of the world. It's the snowball effect in finance, where your investments generate earnings, which are reinvested to generate their own earnings. Monitoring your investments is crucial. The financial world is dynamic. Keep an eye on your investments. But remember, patience is key. Don't be swayed by short-term market fluctuations. Finally, we talked about getting started with investing. It may seem daunting, but remember, every expert was once a beginner. Do your research, seek professional advice if needed, but most importantly, start. Because here's the thing, investing is not just about making money. It's about taking control of your financial future. It's about making your money work for you. It's about achieving financial freedom and realizing your dreams. Remember, the best time to start investing was yesterday. The second best time is now. So what are you waiting for? Start investing today and make your money work for you. And don't forget to subscribe for more insightful videos.